Hello traders, Gary Wagner here, just after 12 noon in Honolulu, 6 o'clock in New York. It is Friday, January 11th, 2019, and this is the Daily Report for Gold and Silver, our weekend review, and what a week we have seen. Pretty much sideways action in gold. We've had a couple of attempts at $1,300 per ounce, but on each occasion, that was unsuccessful. As for today, gold is going to close higher on the day, but only by 50 cents, currently tracked at $12.8790. The high today, $12.9570, with a low of $12.87 even. So we've closed much closer to the low than the high on the day. Now, silver was down nominally, not even a full cent, but trading at $15.64. Platinum lost 1.5% today, a total of $12 in terms of the decline at $8.13. But one precious metal did climb higher today, and that is palladium, currently trading at $12.8120. Compare that to the current price of gold, $12.8790, and we are under a $10 differential between those two precious metals. Now, very weak action in the dollar, but the dollar did close higher on the day, up by 14 points. I was actually expecting it to close lower because we have had a series of alternating candles, but currently we have a 13-point gain in the dollar index at 95.25. Equities market's not really knowing where to go, and we've got very, very fractional changes. 6 points in the Dow, 23,995. When we look at the S&P, that also is unchanged at 2596. And the NASDAQ composite, about a 0.2% decline, 14 points at 69.71. Traders, although we have ended the week with gold closing higher on our weekly charts, as well as higher on our daily charts, both moves were fractional at best. The best way to characterize what we're seeing this week is consolidation and really a sideways trading pattern, as the market was unable to either close above the high achieved a week ago Friday, which was 1,340 cents right here, or the low that was achieved last Friday, which came in at 12.78. Every day this week was an inside trading day, and when we convert this to a weekly chart, what we get is the fact that we are looking at not so much a consolidation, but a doji candle. And let's go ahead and blow that up so that you can see what I'm talking about. This is our weekly chart, and what we can see is, although for the last 4 weeks we have had green candles, and that signifies that the market closed above its open on Monday, we are absolutely seeing not only a consolidating market, but the very real potential that we will see this market reverse from bullish to bearish. We've had a defined trend that has really taken this market. If we market from this particular green candle here, which of course comes after a small retracement, market goes to 1246, and from 1246 it trades back down to just below 1200. So if we start from here, we have seen this market trade roughly $100 higher. And as you know, we mentioned this on yesterday's show, and that is a typical good rally in gold will be about $100. An exceptional rally in gold can be anywhere between $140 and $160 move. We have certainly met the criteria for a good rally, and we are certainly seeing the signs that this rally could easily run out of steam next week. And traders, that is why I want to look at our Heiken-Ashi charts, a Japanese average chart, to give us an indication of strength of trend, because that is what they do best. Now, the weekly charts are obviously going to lag behind the daily, and when we look at our weekly chart, really beginning in November when the market was trading just at around 1200, we have seen consistent green candles, and for the last 6 trading weeks, we have had the absence of any kind of lower wick. Of course, the lower wick in a green candle tells us that the market at some point during the trading session traded at or below the midpoint of the prior candle, because the open is fixed upon the midpoint of the prior candle. So we're still seeing a fairly bullish trend when we look at our weekly charts. However, traders, when we convert this weekly chart to a daily chart, we're going to see something significantly different. And what we're going to see is that first, we've absolutely had a consolidation of range in which we're getting a compression triangle, a series of lower highs, a series of higher lows, and we're getting body size that's diminishing. We've also had during this week 2 days which really resulted in red candles. Now, here's the key. This particular type of formation can be alluding to a key reversal in the market, the point in which we go from bullish to bearish, as you can see, for example, right here, or bearish to bullish, for example, what we're seeing right here. But it can also be indicating a rest area or a consolidation, as we can see in this period right here, or this period right here. So until we get a little bit more information, we cannot say with absolute certainty that we're going to see this market reverse. What we can say is that we're seeing the first signs of weakness, and we still need to determine whether or not the weakness we're seeing is simply a pause or a rest, a consolidation and compression, or whether it's indicating a key reversal. Which takes us to our current trade. We are still long from approximately 1268 in this market. That's back here. We put that on, I believe, on December 20th. Our current stop is sitting at 1278 and change. So we've locked in about $1,000 per contract profit. And that was based on the low of last Friday's candle, and that's here. And so what we want to look to do is pay very, very close attention to what happens on Sunday here in Honolulu, meaning the opening of the markets overseas as it carries over into New York on Monday morning. If we see any kind of genuine weakness in the market, we'll probably want to take our stop to the market and pull whatever maximum profits we can. If we're seeing weakness, then we'll probably not do a rollover, but we will do a sell and then look to add a leg on the April contract when we have determined that that sell-off has concluded. Therefore, traders, my recommendation is to maintain our current long position, maintain our stop, but look very carefully to either pulling profits or raising the stop next week. And the key is going to be whether or not we are looking at a market consolidating before it spikes higher. And that is still possible, traders, because when we have a compression triangle, the basic rule behind it is that you will have a strong move one way or the other, in this case a bullish trend. You will get a compression of range. When it hits the apex, you get a release of that energy, and typically the market will return to the prevalent trend direction, which we have to say is up. So with that in mind, please have a good weekend, maintain your long position. We have locked in profits, so I'm very comfortable about that. This has been Gary Wagner, wishing you as always good trading. We'll talk to you on Monday for the next daily update and review. Bye-bye.